What if I told you the U.S. Federal Reserve could be contemplating a move so big, so radical, it sounds completely crazy, except for the fact it's actually been done before in the past. Now, this move is so big. We're talking $5 trillion big, and it involves the Fed, the U.S. Treasury, dollars, gold, and ultimately a power struggle over the future of the monetary system. And again, all we have to do is look back in history to see this could be done again the same way, and maybe sooner than later. So in this video, I'm going to break down why the U.S. might be forced to make another massive historic move, how this drastic move would impact the U.S.-China economic power dynamic, and we're going to look at the potential risks and global implications of this move, and of course, what this all means for our investments. Now, real quick, if you're new to the channel, my name is Mark Moss. I founded, exited multiple tech companies. I developed multiple 8 figures worth of real estate, and then 2008 came and made me realize that I was missing the bigger picture, the macroeconomic picture, and it cost me big time. I've been studying it for now the last 12 years. I've been teaching it here on this channel for about 5 years, and I want to help you avoid the same mistakes that I made. And this move that's setting up today could be really big, and it seems almost a certain move. So let's jump right in. All right, jumping right in, we are going to jump right into history. My favorite subject, the only one I really liked in school, and of course that's why I use them in all my videos. And more importantly, the reason why I use history in all my videos is because, yes, history rhymes. Those who don't know history are bound to repeat it, and so what I'm going to talk about today seems completely crazy, except for it's been done in the past. So if you don't know your history, you think it could never happen, except for it has, and it most likely will again. We don't know exactly when. Let's jump in. So history rhymes. Now let's go backwards to 1934. We're coming out of the Great Depression. Not just the United States, but the rest of the world were going through sovereign debt crises. All the governments of the world were going bankrupt because of the world wars that were being fought, and the United States, coming out of the Great Depression, was suffering from a sovereign debt crisis. Basically, the United States didn't have enough money to pay its debt and obligations. Now, people in the government, Biden, Janet Yellen, et cetera, they're going to tell you the U.S. government has never defaulted. Of course, that's absolutely not true. So in 1934, the U.S., the rest of the world, and the U.S. was in a massive debt crisis. The problem was that the U.S. government owed a lot of money, and at that time, gold was money. Dollars were not money. Dollars were debt obligations. They were a claim to the gold. Gold was money at this time. It's not anymore, but it was at that time. So the government owed gold, not dollars. The government owed gold. Now, so what happened is, the president at that time, we're talking about FDR, he decided to do an executive order known as 6102. Now, basically, it was called the Gold Reserve Act of 1934. You can look it up, Executive Order 6102. And basically, what happened is they, decided to just seize all the gold from Americans. That was only part of it. But really what they did is they defaulted on their debt. They seized the gold. Congress devalued the dollar from $20 to $35 an ounce, which reduced the purchasing power by 40% overnight. Now, again, to Janet Yellen saying that the government's never defaulted, well, they have. The U.S. offered to pay its creditors in paper dollars, but only in new devalued dollars. So the government owed gold. They said, we're not going to give you gold, we're going to give you dollars. And as a matter of fact, we're going to give you these brand new devalued dollars, 40% devalued. The Constitution default on these Liberty bonds constituted a default on Liberty bonds because they owed the bonds payable in gold. Since the Supreme Court noted in Perry versus the United States, so this is not really open for debate, the Supreme Court ruled on this, Supreme Court Perry versus the United States, and said this was a default. Okay, I'm not going to get super deep into that, but we need to understand why this happened. Okay, so the base of the monetary system was in gold. The government didn't have enough money to pay the gold, so what they did is they revalued the gold. This is the key piece. They revalued the base. By doing that, they expanded the monetary supply. So they went from $20 an ounce, right? And they increased it and they expanded the money supply. So now, let's fast forward to today and see where we're at. Well, we're in a very similar situation. Today, the U.S. government has $35 trillion of debt. It's a mountain of debt. But the problem with the debt isn't that it's just so big, $35 trillion. It's managing the debt. So, for example, right now, our debt to GDP is 120%, maybe a little bit over that. Now, the problem with that is per Hirschman Capital, no governments have survived being in that much debt. Once you get over 125% debt to GDP, it's pretty much game over. The other problem is that the interest on the debt is unmanageable. It's over $1 trillion interest on the debt, which is more than we spend on the military. And so the problem is when you want to get out of that, you don't have a lot of options. You have basically four. Number one, you could have a miracle and you could grow your way out of it. That's highly unlikely at the rate that the monetary base where the debt's expanding and the rate of GDP growth, so that's unlikely. Number two, you could tax your way out of it, except for if we seized 100% of the wealth from the billionaires, it would barely be a drop in the bucket. Three, what you could do is go in massive austerity, so just slash the budget and try to live under your means. That's probably not going to happen. So then number four, the fourth option, is a default, like was done not that long ago. So what does that look like, and what options do we have? So if we want to revive the playbook from back then, again, I know it sounds crazy, except for it was done before, what we could do is we would revalue Fort Knox. So in the United States, Fort Knox holds all the gold. There's about, rumored to be, allegedly, we don't know, it's never been audited, 147 million ounces, or somewhere a little over 8,000 tons of gold is sitting there in Fort Knox. Now, the book value of this was set in the 70s before we started to get off the gold standard, and so the book value is at $42 an ounce. So we're sitting on 147 million ounces at only $42 an ounce. Now, one thing the government could do, and again, sounds crazy, but it was done in the past, is to revalue the gold, to remonetize the base and expand the base. So we could take the gold from $42 an ounce to $20,000 an ounce. Now, before this, you click off and think this is crazy, let's break this down. If we did this, if we took the gold from $42 an ounce to $20,000 an ounce, and most people think that the gold has been suppressed and they don't want the price of gold to rise, which has maybe been true, they don't want it to rise until they're ready for it to rise. So just like they did, went from $20 an ounce to $35 an ounce, they could take it from $42 an ounce to $20,000 an ounce. And that would add $5 trillion to the U.S. Treasury's balance sheet. Now, when there's $35 trillion of debt, $5 trillion doesn't sound like a whole lot of money. However, it is in some regards. So, for example, that debt, that $5 trillion could be paid onto the long-term debt, which is the highest interest rate. And so that could greatly reduce the amount of interest debt that's owed. So that makes the debt service much more manageable. So we have interest rates coming down already. We pay off the big debt that has the higher interest rates. We can bring this debt service number way down, which makes it much more serviceable. The other thing that would do is we'd increase the dollar perception. So right now, other governments of the world see the fiscal problem that we have in the United States, how much money is being printed, how quickly the base is being debased, and there's a lot less demand for treasuries. We see the rise of the BRICS and Russia and China, and they don't want to store their wealth in U.S. treasuries anymore. They're buying gold instead and things like that. And if they were to do that, it would increase the perception of the dollar as now being stronger. The debt to GDP would be lower. It'd be backed by gold. And so then it might have more demand for the United States. There's a lot of reasons why the U.S. would want to do this. However, it's not just that simple. There's another reason why the U.S. would want to do this. And this really comes down to the economic power struggle that's going on between two titans, the U.S. and China. Of course, the U.S. is basically the dollar-based monetary system that we've had, and China has been the rising power that's now challenging the supremacy of the U.S. dollar. So here's where things get interesting. Would the U.S. want to just do this out of the goodness of their heart? Of course not. Would they want to do this to save their debt situation? Maybe we're not that far along. But in the face of what China's doing, this is where things get interesting. So what am I talking about? In the game, in this global economic game, you have a first mover advantage. So China is ramping up to do something, and if they do it first, the U.S. would be left out in the cold. However, if the U.S. moves first, they could basically neutralize China's advantage. Let's break this down. Okay, so China, we know, has been increasing the amount of gold they have. Now, China doesn't really tell the world how much they have. I guess similar to how Fort Knox hasn't really been audited either. But what we do know is at least over the last decade, China has allowed massive amounts of companies to come in and mine gold in China. However, the gold can't leave China. So come mine it in China, but then sell it to China. China has also been importing massive amounts of gold. They don't really report this properly. They buy it through proxy banks and things like this, so it's all sort of hidden off the books. There's a couple of reasons why they would do this. Number one, they don't want to show the world how much gold they're buying because that could push the price of gold up too much. You don't want to tell the world. You don't want to push the price of gold up if you're trying to buy a bunch of it. Number two, maybe a sneak attack. They want to come out and just announce what they have and set the world into a shock. And that's exactly what we're talking about. So what China has been doing is buying lots of gold. There's reports maybe up to 2023 they had 2,000 tons of gold. Jim Rickards says that they probably have up to 4,000 tons of gold. They could have even more. We don't really know. We know that China, so with their private holdings, might be as much as 28,000 tons of gold. And I guess they could seize that like the U.S. did at one point. They are a communist nation. And so China has been buying all this gold. Now we know that they are starting to back their currency with gold, which has now started to facilitate a lot of trade over for oil in Saudi Arabia, things like that. So they are already responsible for pushing the price of gold up by using it with their currency. So they've been cornering the gold market, they've been buying a lot of gold, and they're already starting to back their currency with gold, which is pushing the price of gold up. And so one day they could just say, okay, we're going to be fully backed by gold, at least to some percentage, which could push their currency up into a lot of demand. But the problem is that would then push the U.S. dollar out. So we already have these BRICS power struggle over which currency to use, where to store their savings. And so if China were to do that, it could start to pull away from the dollar, go to China. However, if the U.S. does it first, they could basically squash China's ambitions. By U.S. doing that, it would reinforce the dollar strength. So it's already got the network effects. It's already there. It'd become very strong. Number two, it would discourage all these nations from moving away. So all these BRICS nations, it could bring them back into the fold. And so really what we're talking about is geopolitics, the power struggle over the world, more than just economics, all right? So you have to look at both. You have to understand the power struggle as well as the economics of this. But really, it's a gamble, right? It's a gamble. What happens if this happens? And if, like all issues, there's good and bad. Things are good and bad at the same time, so there's risk and reward of this happening. What would be the rewards of the United States doing this first, preempting the move? Well, obviously, $5 trillion could go into the economy. Bring down the debt, bring down the debt to GDP levels. We would see better debt service, right, and be able to manage that better, reduce the debt burden. We'd have a buffer against any downturn. So now the U.S. Treasury would sort of have this war chest. So if there's any more recessions or anything like that, trade wars, they'd have a buffer against that. And again, like I said, it would also reinforce the dollar's reign. So now as sort of countries are starting to try to move away from the dollar, it would bring all that back in and sort of cement King Dollar's position, at least temporarily. However, there's also risks. So some of the risk would be, one, massive inflation. Now, you know, I'm an inflation bull. All I talk about is get ready because there's a lot of inflation coming. And so we could see a lot of inflation by bringing $5 trillion directly into the economy. You think in 2022, with all the stimulus that we had, we got up to 9.1% CPI, consumer price inflation. That might be nothing if we were to see that. Number two, we could see tensions with trade partners. So obviously, the whole world depends on each other. The United States specifically depends on lots of nations like China to give us goods. And so if we did that, it could create a lot more tension with these potential trade partners. It could start off a lot more currency wars, because obviously the U.S. is doing this to manipulate their currency, and other nations would then start to manipulate their currencies in response to that. We could also have a lot of domestic opposition to this. So the United States government is not a monolith. We're supposed to be a constitutional republic. And so there's a lot of people inside the government that have different opinions, as well as the people in the United States, and there could be a lot of domestic opposition to this. So potential risks and potential rewards, but the game theory is here. China looks to be going this direction. The rest of the world is starting to move over towards China. And if the U.S. wants to save itself, it would have to do this before China announces it. And we don't know when China is going to announce it. So the game theory is in effect. Now, what are we going to do about it? What's our move as investors, as pawns in this game? Inflation seems inevitable. Regardless of which way the U.S. government goes, even if they don't do this play, then they're going to have to deal with this debt, which means they're going to have to continue printing. Or they do this play and they get more debt. And we're still going to see the power struggle with other countries, and that's going to be more inflation. And so inflation seems inevitable. Also, currency manipulation is coming. So whether the U.S. just continues printing, that's manipulation, or they do a gold revaluation, or China, we're going to see currency manipulation, which leads us back to more inflation. Because of that, we want to be buying gold and other hard assets, right? They're going to be climbing. So gold, other hard assets, Bitcoin, real estate, things like that. And we want to front run the news. Again, we know what's inevitable. I don't know the time frame, but we know it's inevitable. We can see China already angling. You can look at the news with Saudi Arabia and trading with gold. And so we have an opportunity to front run the news, knowing what's inevitable and move into these positions before it's too late. All right, that's what I got. Let me know what you think about this video. Give me a thumbs up if you like it. Thumbs down if you don't. That's okay. At least leave me a comment and tell me why. And that's what I got. All right, to your success. I'm out.